On October 1st, 8 million shares were reacquired as treasury stock. Treasury stock is a control equity account. Therefore, it will reduce the total amount of shares outstanding. And we can see we will reduce it by 8 million. And don't forget, you need to calculate fraction of year not outstanding. So it's from October 1st to December 31st. It's 3 months out of 12. All right. After doing that, we can see the denominator now is 75 and the EPS becomes 2.05 per share. When a senior class of shareholders, like preferred shareholders, is entitled to a specified allocation of earnings, like preferred dividends, these amounts are subtracted from earnings before calculating earnings per share. We subtract the dividends on cumulative preferred stock even if not declared this period, the presumption being that dividends eventually will be paid. Preferred dividends. Same company, same situation. If it has preferred stock non-convertible from January 1st to December 31st, 5 million shares, 8%, $10 par value. So the effect on the earnings per share will be, let's see the numerator, the net income is still 154 minus the preferred dividends. How we calculate that? 8% times $10 par value times 5 million shares. So the preferred dividends will reduce the numerator by 4 million. So the new earnings per share will be $2. Diluted earnings per share. Potential common shares. Securities that are not common stock but might become common stock through their exercise or conversion. Complex capital structure. When any potential common shares are outstanding. Example of potential common shares is convertible bonds, convertible preferred stock, stock option, contingently issuable securities. A firm with a complex capital structure reports two EPS calculations. Basic EPS ignores the dilutive effect of such securities, and second diluted EPS incorporates the dilutive effect of all potential common shares. Option rights and warrants give holders the right to exercise their option to purchase common stock at a specified exercise price. Dilution resulting from the possible exercise should be reflected in the calculation of diluted EPS, but not basic EPS. To include the dilutive effect of a security means to calculate EPS as if the potential increase in shares already has occurred. Two assumptions. First assumption is options were exercised at the beginning of the reporting period or when the option were issued if that's later. And the second, very important, cash proceeds from selling the new shares at the exercise price are used to buy back as many shares as possible at the share's average market price during the year. Now let's see the example of stock options. Still the same situation for Sovereign Financial Corporation. And now we see there is incentive stock options for this company. Executive stock options granted in 2019. Exercisable after 23 for 15 million common shares at an exercise price of $20 per share. So let's see here. So 15 less 12, that's the difference. How we get 12? 12 million times 20 over 25. Because 20 is the proceeds we received and 25 is the market price. So this is the difference. This is the proportion we can repurchase from the market, subtracted from the total shares outstanding granted to the managers. The 3 million is we have to issue, and this 3 million is the additional or incremental shares to our denominator.